Welcome back to another Stock Market Open live stream. My goodness, I apologize. I was up until about 4, and I just didn't make it when it came time for my alarm at like 4:45. I'm like, 45 minutes will be fine. And I didn't wake up, with the exception of all of a sudden I wake up to because I was with Max and Lauren, and Max all of a sudden he turns on the TV and everything gets really bright, and he's staring at me like this, Dad. And I'm like, oh no. I never wake up after Max. I had a little bit of a long night helping someone, but that's okay. Here we are, and let's go ahead and catch up with what's going on. So the first thing I want to do is I want to look at data sets, which I know we got lower unemployment claims this morning than markets were looking for, which is good. I still don't think unemployment claims are that much of a leading indicator, but they've still been something since the July payrolls report that we got in August that markets have traded off of. And the initial jobless claims for September 14th, the week of September 14th, they came in at 219,000, and the expectation was 230,000, which is pretty impressive. So you've got a little bit of a beat there by about 11,000. Now, you did get an upward revision of about 1,000 on the initial claims for last week, so 1,000 more than expected, but you missed on continuing claims as well, 21,000 lower than expected and 7,000 lower on revisions. So you got, good news essentially on the unemployment claims, which again, I don't see it as a leading indicator, but that's okay because you had a leading index reading that came out. The prior reading was negative 0.6%. The current reading was expected to come in at negative 0.3. It actually came in at negative 0.2. So you had a beat on the leading index. The Philadelphia Business Outlook came in positive today as well, so that beat. So Philadelphia Biz Outlook beats, the leading index beats, and continuing claims beat for what that's worth. Those are just some of the initial numbers that you get. The leading index just came out, by the way, just about a minute ago. You also got existing home sales, which came in at about 3.86, slight miss to the expectation of about 3.9 million. So kind of good data across the board. A lot of folks are looking at this going, okay, I guess we don't have to price in any kind of recession risk. Now, I'm already of the mindset that markets have done a very good job of unpricing recession risk already. It's one of the reasons we've seen some of the movement that we've seen in the yield market. Take a look at this also. This is the Atlanta Fed GDP. And the Atlanta Fed GDP, somebody says F your puts. See, I don't have any puts. So it's always funny. I feel like people come and they're like, oh, you've been bearish, and so you must have puts. And I don't have any puts at all. But that's okay. That just is a sign of them not being capable of being able to understand what somebody's positioning is, because they're not paying attention. But that's honestly more of a they problem than a my problem. But so look at the Atlanta Fed GDP read. So the Atlanta Fed GDP read ran all the way up to 17% a couple days ago. We really saw this accelerated by retail sales data and some of the recent consumer enthusiasm that we've seen. Now, that's dropped down a little bit to about 2.9%, but still doing decent. And the domestic investment growth segment is actually nicely positive now. This had actually moved negative for a while there at the end of August, beginning of September. And so it just shows you some of the volatility of this data here. But nonetheless, the way to sort of look at this is what you've got is now markets are saying, okay, cool. So we've got the Atlanta Fed GDP numbers that are looking pretty good. We've got Jerome Powell, who's confident essentially in a soft landing. It's almost like he's declaring victory is really what you have, right? And then what you have is you have this environment of hey, well, if we're not going to have a recession because of what Jerome Powell is talking about, then hey, or what not what Jerome Powell is talking about, but what has been feared that Jerome Powell might be talking about, then hey, why price in any kind of downside protection? Go to the moon. Let's take the beginning of the interest rate cycle and rally. And it seems like that's what we are accomplishing now. Yeah, I know somebody says, he literally says, we're not, what's it called? He's not declaring victory. So you really have to look at what his actions are versus what he says. This is the same thing that the Wall Street Journal editorial board suggests. You know, when you have the Federal Reserve Board writing down their upper end of inflation expectations way lower than they've ever written before, and you have the Federal Reserve saying, hey, the focus is now on the labor market and we're looking to get ahead of the labor market. We don't think we're behind. What you're really doing is, what you're saying is, we're declaring victory on inflation and we're moving to the labor market. We're going to move rapidly here. Now, look, don't get me wrong. I mentioned this before, that in general, I thought that the best thing for a soft landing would be the Federal Reserve going 50. Now, I thought that there would actually be more uncertainties that would spawn, as you know, markets would be a little bit more concerned about data coming up. But so far, that doesn't appear to be the case. I mean, look at what some market moves are here. You've got Tesla, for example, up about 4.5% right now. This is a pretty healthy rally here. Palantir's almost at $37. You've got Microsoft up about $4.40. Look at that rally in Apple, and someone just keeps going and going and going. Pretty impressive. You've got about a 3.4 here. You've got Bitcoin. Look at this move on Bitcoin. Right now, here are some of the lines to pay attention to on BTC. You've now bounced off of the 61.7 line, and you're coming up to about that 63,840 line. But look at this. I don't actually have another line for Bitcoin until you get all the way to about 69,000. Pretty incredible. Pretty incredible. And so then you've got, what else do you have? You've got bond yields actually up a little bit. Now, this is an interesting one. Bond yields moving up. Let's talk about this, because bond yields moving up is actually something that restricts the economy. And so this creates some interesting problems. Look at the 5-day chart on the 10-year. This is really interesting, because this right here is a fascinating sort of reversal in this longer term downtrend that you've had on the 10-year Treasury. Let's zoom out for a moment on 6 month. So here's your downtrend, right? Here's your downtrend since the second wave of inflation fears. So right here, you have second wave of inflation fears in April, where the 10-year is sitting around 4.6. It peaks out somewhere around 4.62, peaks out again somewhere around 4.43, and peaks out again around 4.25. This downtrend has been very clear. It's actually been a relatively easy bet to make that you have this downtrend in Treasury yields. Now, what's fascinating is you're now seeing, despite a 50 basis point cut from the Fed, which I had expected, you're seeing a rise in Treasury yields, which that's the opposite that you've been seeing for expectations, right? And it's possible that markets are either heavily pre-priced in a move here in Treasuries after a potential double or a 50 on the Fed, or you're really just trying to unprice recessionary risks. Now, I personally think that recessionary risks haven't really changed. I think that Jerome Powell's procurements yesterday on data that is really lagging, which were unemployment claims on the state of the economy, or misleading. Whereas if you look at, oh wow, look at what's going on with what's it called? The beige book, for example, which he mentioned. He's like, oh, well, the weakness in the beige book, that's why we're going for a 50 basis point cut. So it's kind of like interesting. Okay, so you're pointing out leading anecdotal evidence that suggests economic weakening, and you see job openings slowing, which suggests economic weakening. But then, hey, everything's okay today because, unemployment claims are good. And then today, unemployment claims came in lower than expected. Everything's Gucci. It seems a little misleading, but hey, all good. The best case scenario is that you don't have a recession. Nobody wants a recession. Recession is really worst case scenario because that's how you really end up with substantial pain in not only markets, but also at startups or businesses or otherwise. Anyway, so let's take a look at some of the market movers here, and let's go sort by what some of the action is that we have right now. So you do not have a full page of red right now. So you generally end up getting a full page of red in the day, but you don't have that yet. And let's go sort by some of the highest movers today. Look at this. You've got Peloton up almost 7%, actually 7% now. 7% on Peloton at under $5. You've got Coinbase moving up at 5.5%. Red Robin, which is a company, in my opinion, going bankrupt, basically, up 4%. You've got AMD up 4.5%. Look at that, 155. That means you've really broached those 140 levels. That's pretty impressive. Then you've got even Apple. Wow, after the iPhone release or drama about lower potential iPhone orders, take a look at this. Look how great this is. I mean, this is Apple's going up to $230. This is the higher you move on stocks, the lower the odds are that you have a recession. And so in a weird way, the higher stocks go, the lower your recessionary odds are. And I think that's the sort of the pricing that you're seeing in markets right now. Now, that doesn't necessarily mean that, markets aren't primed for substantial volatility in the next month to even 2 months. Getting through the election, getting through earnings season, and some of the upcoming data. But it is quite impressive. This is a really impressive move here, not only by Apple, especially in the face of some of the more recent fundies, but also, the Qs. Look at this, 2.25% on the NASDAQ. You're now sitting above that 476 line. Take a look at this. So this is 476. I don't even have a line right here where we sit for the Qs. It's pretty impressive. I do have a line for Tesla. Next stop for Tesla, honestly, 247. Pretty good. This is a pretty nice movement up. Pretty incredible. Valdo says Kevin's working for the suits. I wish I worked for those suits. I'm just kidding. No, I don't work for anyone else. I work for myself. You should know that. I always think it's funny. Some of the comments I get, people have all this speculation or whatever, and it's like, oh, no, it's okay to be a dude on YouTube that has opinions, right? But look at this. You can sort of continue to rally here. More rally, you're getting more rally, and it's likely that you had some of that residual profit taking right after the Fed meeting yesterday. It's probably one of the reasons the rally somewhat died yesterday. And now you don't have that profit taking anymore because those who were primed to profit take on stocks have. And now you're in sort of Fed pivot rally mode. And this is where folks then really have to analyze, okay, so where do we sit? Is this victory of a soft landing, or are we still potentially in a trajectory of a recessionary environment? Well, ironically, the more the market moves up, the better it is for avoiding layoffs, because frankly, the market moving up is money for the underlying companies in the stock market, right? So it's actually pretty great. So let's take a peek here at what the Doomers have to say for a moment. We'll jump on over to them. And then let's go to... Nope, Doomberg is on commercial. And let's take a peek at... look at Bitcoin. Yeah, this is actually a really nice rally. Again, I think my next stop on this one is 63.8. 63.8. is the next stop here, so not bad. And then you've got, let's see here, yeah, in 2008, you made an all-time high after a 50 basis point. Yes, there was actually substantial euphoria after the 50 BP cut, mostly because people thought that the 50 basis point cut would change the trajectory of the economy, right? So let's zoom out for a moment and let's look at that. You really have to go all the way down, quite a far bit down here. So let's go to 2007. You know, it's remarkable to me that it was really the same date that you had a, you know, what's it called? An interest rate cut. Take a look at this right here. So you had an interest rate cut right here. Right, it was September 18th. So right here between these two candles here. And the Qs over the next week were up about 2%. And you could actually see that the Qs ended up moving up, frankly, almost, what is that? You were on the 14th, you closed at 43.46. Let's write that down, 43.46. And then I'm going to divide into that a high that you hit at 48.63. This is actually very interesting. So you actually saw the Qs move up about 11.9 percentage points after the Fed rate cut in 2007. Let's go ahead and write that down. I find that very interesting. So let's see here. Okay, today is the 19th. Let's make that update really quickly here. Okay, so let's go with, let me put today's date in, and there we go. Always takes a little second to set that up, especially when I'm as late as I have been today. Okay, so 2008. Okay, recession. I'll just say. On September 18, 2007, which is literally 17 days and 17 years and 1 day ago, the Nasdaq 100 rallied about 11.8% to a new all-time high within, let's see, November 2nd. It's about roughly our election timing there. That'd be about within approximately 6 weeks after the surprise 50 basis point rate cut. Markets then proceeded to deteriorate. You went from 48.63 at a high, 48.63 at a high, and over the span of probably about 9 months, that's when you hit your low. No, it's actually more like a year. Over the next year, you ended up down 22. Wow. You ended up about 54.6% over the next year. That's crazy. Deteriorate 54.6% over the next year. That's incredible. Wow. Okay. That's sort of an interesting sort of like look at the historical. Now, what also is interesting is the two tens right now, they are sitting pretty steep actually. So, and this is what's generally referred to as a bear steepener. So I'm going to call it the bear steepening. Despite stocks rising, bonds are bear steepening, which is when bond prices fall, therefore yields rise, and the curve uninverts further. We're now at 13.27% basis points uninverted. Usually, when you get these substantial spikes up to about 50 basis points. We're only about 13 right now, but that's usually when you're at the beginning phases or beginning innings of a recession. So, coming out of inversion, so I'm going to say that, coming out of inversion, usually the spike from 00 to 050 BP uninverted, is the beginning of your recession. Now, obviously, Jerome Powell is hoping to get ahead of a recession here. That's obviously the goal. And so at this point, you have markets reacting to, hey, this is wonderful. Jerome Powell's trying to get ahead of a recession, and we can rally just like we did in 2007. And it's sort of a bizarre comparison. I think one of the reasons that this is such a bizarre comparison is, you look at the exact same date that you ended up having this rate cut situation in 2007 as you do now, which is quite remarkable. Now, another thing to watch is that the market yields are actually moving up right now, which is odd because, typically you would want to see the Fed accommodate the labor market. And so the Fed's accommodation of the labor market is interesting right now. So I'm going to say Fed accommodation of labor market. So if Fed believes a stock market rally will help the labor market, then it's working, right? If the Fed believes lower yields help the labor market, then the opposite is happening. And that's really what's very interesting here is interest rates are going in the opposite direction. It's very interesting. So is it the stock market that benefits the labor market, or is it yields that benefit the labor market? That's the question. And so, I've long argued that if the stock market goes into a recession, you almost certainly will see layoffs. I think a pumped stock market is rightfully so the opposite of that. A stock market at all-time highs doesn't beget layoffs. Now, that doesn't mean you can't still have some kind of correction that occurs, but the higher you go, the further you are from probably that threshold of layoffs, right? So let's put it this way. Let's try to analyze this. Kevin's stock market correction and layoff theory, right? So let's make an example here. Let's write down and say, if X is the level where the stock market is so pained that it leads to layoffs, then obviously X plus, I don't know, let's call it all-time highs on the Qs. I think that's 505. Let me see quickly. Should be about 505, maybe 504. There it is. 503.52. 503.52. And then we hit a low of, I think it was about 439. Oh, intraday, 423. Let me get the closing, though. 435. Okay, 435. That's about a 15.75% rally. 15.75%. X plus 15.75%. QQQ from 435 close to 503 all-time high would obviously insulate from that X point by, now I have to do the math in the opposite direction, 435 divided by 503, about 13.5%, 13.5%. In other words, markets could fall 5 to 10% all day long and not trigger that X point. So yes, the market rallying, therefore, does help remove us from that X layoff point, right? However, if what's up, buddy? How you doing? You still blue? You gonna go to school like that?
No.
Yeah. Okay. You gotta think about that.
I have purple Gatorade.
Purple Gatorade. Okay, yeah, that'll do it. All right. So if it's so bye. If this therefore I'll say so if the stock market rallying prevents layoffs, Jerome Powell is succeeding, right? And basically what we had was a hawkish 50, right? We got a hawkish 50 that said everything is fine. We're being preemptive. Okay, cool. That doesn't align with history, but in terms of like not avoiding a recession, but it does align with market rallies. So this historically, I'll say, aligns with market rallies, but not with avoiding recession. Okay, interesting. So then, the second thesis is here that, these rising yields somewhat undo what the Federal Reserve is trying to accomplish. So let's write that down. Rising yields. To some extent, I'll say this, to some extent, rising yields hurt the Fed's work in providing cheaper borrowing to businesses to retain employees or to hire new. So, ironically, this 50 basis point cut, ironically, the 50 BP cut with hawkish tone reduces the easing the Fed is trying to accomplish, which ironically increases, layoff pressure. But again, if you have a stock market at higher levels, that your larger companies might be insulated. But I'll say that with stocks at higher levels, larger, I'll say public companies may be less affected, and smaller private companies may be hit harder. But it's an interesting way to look at it. And so I think that's somewhat the environment that you're getting right now. Take a look at this. Q's still rising, 2.6%, really impressive. Really, really good rally here. Almost had $37 on Palantir, which is remarkable. Look at that move on Tesla. 5% on Tesla. You're capping out a little bit at about 240 right now, which is weird because it's not where I have a line. My next lines are really 247 and 250, which is bullish Tesla. And if I jump into end phase here, you've got this return to about 120, which is also really interesting because, I mean, if this is supposed to be an interest-sensitive rally, then you need to move, up substantially higher. Like you would probably see a little bit more of a move, in end phase, like you would in Tesla. So I think that's very interesting. Okay, very well. So let's see. Okay, then you have BTCs. Oh, why did those keep doing? Hold on, my AirPods keep going. Oh, let me turn off. Just disconnect from that. I guess that doesn't really matter. All right, that's fine. Okay, so interesting move on end phase. You would expect to see some more activity there on end phase. And Peloton, giving up a little bit, is really running there for a while. And it got hit a little bit here, bouncing off of, what do we bounce off? Almost $5. Yeah, okay, that's a fair psychological level, though. You've got Disney, that's almost back to $95. This was $89 not too long ago. I actually think Disney's a great company. Ubiquity's at $213, not bad. You've got, let's see, what else you have here? You have ARM Holdings, 3.73, not bad. You've got Etsy, 1.1, cool, Delta 1, Dell 2, Dave & Buster's 2. Just sort of a broad movement here. Obviously, triple leverage, shorts are down. This is actually, days like today are why I don't like triple leverage positions, because triple leverage positions, they can get destroyed very, very rapidly. And it's very, very difficult to recover from some of the holes that they fall into. So, let's see what else we have here. Then you've got Tupperware, we know is going BK. Yeah, look at that continued rally there on the Qs. Probably in the trajectory of trying to revisit all-time highs there on the Qs. And I think you have now, if you go to the SPY, because yesterday you were at intraday highs, which you lost after the Fed meeting, but being up another 2%, yeah, there you go. There you have it. New all-time highs. Your previous all-time high close was 564. You're now at 571. So you're 1.5% now above, breaking through those all-time highs on the S&P 500. Not bad. It's actually really good. This is quite frankly, pretty bullish. It's been a very bullish movement, and again, it does reduce that risk of some kind of market correction induced layoff cycle. Now the question is, okay, cool. Is there any data that you really have to worry about? Well, I mean, not today. Not that I think unemployment claims are leading anyway, but unemployment claims were fantastic. And I want to see what we have. So let's see here. Bonds are still responding to the Fed's cut. Bear steepener extending today, with the Fed potentially more likely to stick a soft landing. That makes sense. Let's see here. Bets on small caps if you're into soft landing. Of course, that makes sense. Small caps usually do very well in, an environment coming out of recession, right? That does very, very well. Then you've got, I want to see how oil is moving today. Let's see here. Oil! Oil today is up 1% on oil. Also probably moving in the same direction. This sort of anti-recession thesis move. Look at that. Very nice here on BTC. Again, I think the next stop here really is about that 63,840 line. So you want to watch that. And you keep going over here on the Qs. So, not bad. Not bad. So, very, very cool. Okay, so now let's go with, let's see here. Weakening dollar. Oh yeah, let's take a look at that. Okay. Let's see, USD, who are we going to compare it to? Let's go to Euro, for example. So if I go Euro to USD, and we go out on a 1 month on the Euro, Euro has strengthened in just the last day or so. We can also go to U up, and this should be going down. U up, yeah, I mean, it's barely moving down. Dollar's barely moving down, right? Very interesting. But also makes sense as you get sort of a 50 BP cut. Okay, Bloomberg's talking about ESG. So let me go jump on over to, let's see what they're saying over here. Lego, what are they going to go public? That'd be so cool.
Product launches featuring teams and drivers. Lego already has
Lego and Formula One to partner up. Oh, well, that's kind of cool.
With McLaren. And clearly, David, building on that, adult fans of Legos, AFOL folks and group, they are a big, big business these days.
Yeah, indeed they are. Bertha, thank you.
They need to build kid Lego too, because there are increasingly a huge number of kid fans of F1. It's my 2 cents.
Well, your 2
2
cents
at
would
home.
matter.
Yes.
Yes, given your own enthusiasm for F1.
There's a lack of toys.
Not
There's
to
actually a lack of toys and costumes and paraphernalia for kids.
See the things you learn here?
She takes this seriously.
Oh, quite.
Yes.
Quite. All right. Well, we're moving on to other subjects as well. Yesterday, I had an opportunity to sit down with Mark Rowan. He's the CEO of Apollo Global. We had a wide-ranging conversation, and Rowan has very distinctive views on the changing nature of markets, in particular his belief that we're in the earliest stages of a significant change in the way not just institutions, but individual investors will choose to invest when it comes to making a decision between the public markets, both debt and equity, and the private markets. Take a listen.
I look at a traditional investment portfolio, and we can have some fun with this for individuals and also for institutions. They've mostly lived in a three-flavor ice cream world. We've had vanilla, chocolate, and a little bit of strawberry. Stocks and bonds and alternatives, so-called privates. What we're watching happen and what's going to drive our business, and I believe drive much of our industry over the next period of time, is people are going to move out of this little bucket called alternatives, where our entire industry has been built for 40 years, and they are next going to go to their fixed income bucket. And they're going to go to their fixed income bucket, which has become 100% beta, no excess return per unit of risk. And they are going to begin to ask questions like, how much liquidity do I actually have in my fixed income portfolio? By recent measures, it would take you 5.
Yeah, it's a little boring. Okay, so interesting. You're talking like ESG over on Bloomberg. You're talking boring over here on CNBC. I'd love to hear a little bit more market commentary, but that's okay. Yeah, there we go. So let's go ahead and soon we're gonna hop on over into the course member live here, and I think the next stop really, I don't know. Let me see where the SPY's next stop is going to be. Let's see here. Okay, so SPY almost up a full 2%, which is pretty nice, remarkable move. Really from here, breaking that 563 all-time high in a little bit uncharted territory here. Really until 675, which is remarkable because in a soft landing, you could probably pull that off. You could probably pull that off. So anyway, this is very interesting because what I would say is, I think as an individual, you kind of look at the market and go, cool, this is great. If you're exposed to the market, this is a fantastic move, and clearly markets are very enthused by the Federal Reserve's movements here. The question then becomes, do you have hedges in the event that there is a larger downside? And then, of course, the question is, how much are those necessary? What if there is just no landing at all, right? This idea that we have to have a soft landing argues that markets have to, slow down. That markets need to for some reason, correct. And theoretically, I mean, people thought markets had to correct because there was going to be a double dip recession, and you thought you were going to get that between like 2012 and 2019. And I remember that during that time, my whole thesis was, whatever, man, I'm just gonna buy real estate, and that's it. Which I think is really, really interesting. I'm very, very enthused still in real estate. I actually think no matter what the scenario here is in the stock market, real estate in high quality areas continues to perform very, very well. So very enthused and very, very excited about that. I guess we'll see. Okay, let's see what else we have. Then you've got SPY just peaked out at almost 572. And I want to see Tesla here. Tesla peaked out about interesting kind of rejection point. This around 240 level. This is roughly the second time today that you've seen this this move here. Let's see here. Let me see here. Okay, that's good. Okay, perfect. Then let's see here. BTC. 63.5 kind of cap out. Okay. It's, almost 4% on Apple. I mean, that's a phenomenal day. And look at that run there on the Qs. Really, really good. Okay, let's go to... I want to see if the suits are saying anything else. So, Fed Treasury holdings haven't reduced effective bond issuance. While interest rate policy has understandably been at the forefront of the market's collective action vis-a-vis the Fed, balance sheet risk remains part of the normalization process. Thank you very much, Mr. J. It's perfect now. You did a very good job. You going to have fun?
No.
No? You going to go be bored?
Yes.
Okay. Bye. Enjoy being bored. Bye. Let's take a peek here. Let's see. Fed cut. These are interesting headlines. Look at this. Fed cuts rates for the first time in 4 years. With inflation easing, half-point drop okay. Front of the Wall Street Journal. I'm also still not sure why I get 2 of them. I think I'm going to have to hit them up and let them know they're making a little mistake, but that's been happening for about the last week, it seems. So if anybody needs a spare copy of the Journal, here you go. Fed goes big with half-point cut. Yeah, I don't think I have a double subscription. Fed's half-point cut to interest rates signals era of easing has begun. It's actually kind of a good way to put it. Era of easing. Kind of like that headline. Okay. So back to, wonder how Ethereum's holding up versus Bitcoin, because it's been lagging it, but it should be doing well today. Barely. I mean, look at that. You're not really participating in that rally. Oh, look at that. 2,400 bounds. I guess somewhat. You know, you're up 150-ish bucks or whatever, 1.25%. That's not bad. And then the Qs still had a little bit of a cap out there at about 485. Okay. And what else do we have here? Tesla. Not bad. Not bad. All right. 5%. That's fantastic. Yeah, very, very interesting rally. I'm like, my biggest curiosity now is, does this market rally continue, right? Does this continue to move in the direction of rally mode? And I guess we'll find out over the next 6 weeks, which I suspect will have quite a bit of volatility. And whether or not that volatility will lead to the Fed talking down yields will be fascinating. I wonder if we have a Fed calendar for when these folks talk. Fed Reserve. All right, let's see here. Federal Reserve. FOMC statement. Calendar. Today's the 19th. I know that calendar doesn't help us. What about speeches? No. Okay. That doesn't do us much. I wonder if I can get a Fed calendar elsewhere. I'll find out when these knuckleheads are going to talk. I don't know about you, but generally I don't like wearing the watch in the first thing in the morning. So it's the perfect time to charge it. All right. Janet Yellen's yapping. Fed move very positive. Labor market is normal, healthy, like pre-COVID period. All right. And doesn't look like we have Fed speak. Oh, there it is. FOMC speak? FOMC speak. Oh, here we go. Nope. No forecast. Oh. Interesting. Events? Ah, I got it. I have found it. I have finally found it. Okay, you ready to write some of this stuff down? I think this will actually be very useful to write down. So let's write down Fed speak. Somebody donated $2 to say how's Solana looking. I don't know. How is Solana doing? I'm gonna go look at it really quickly. It's up 10% in 24 hours. It's pretty good. Let's go. Here you go. Look at this. Nice little bounce. I mean, you're not at those all-time highs, obviously, of 21, which is fine. And you're also not at those recent highs where you broached $200. But, you know, hey, still a nice movement up. So, not bad. Okay. So, Fed speak. Okay, so let's write down Fed speak coming up. Okay. Harker speaks Friday at 2 p.m. Okay, then you have the 21st, 22nd, 23rd. Then you have Bostic Monday at 8 a.m. Oh, there's a lot. But they don't really start until next week. Goolsby Monday at 10:15 a.m. Those are going to be Eastern. Then you have Kashkari Monday at 1 p.m. Oh, there's a lot of Fed speak coming. Then you have Tuesday, Wednesday, Thursday. Collins Thursday at 9:10 a.m. Powell gives pre-recorded opening remarks. Well, that's lame. Thursday at 9:20 a.m. Williams Thursday at 9:25 a.m. Oh my god. Barr Thursday at 10:30 a.m. Jeez, Lord, the Fed speak in the next week. Oh my god. Kashkari again. Thursday at 1 p.m. Collins Friday at 9:30 a.m. And then Powell again on the 30th, which is 29th, Monday. 2 Mondays from now at 1 p.m. Fed speak. I'll put FOMC. Whoo boy. Whoo boy. That's a lot. That's a lot, eh? So, okay. All right. So you got a lot of Fed speak to look forward to. And then, of course, you have CPI, jobs, and earnings, which will probably carry the heavy weights going into, next, the next 6 weeks. My goodness, I hear someone screaming out there. I have this problem where once it gets to like 7 a.m., I think Jack comes in and he leaves that inside door open. Or it might be my fault. I'm not sure. But anyway, if I don't close the doors, I could hear screaming. Makes it a little harder to work. But that's okay. I'll go help in just a moment to see how I can help. Sometimes even just me showing up to the little girls, if they're screaming like this and I'm recording or I'm working in the studio or whatever, I come out and just hug them a little bit. They get so happy and it makes them stop. So I'll probably go run and do that. But actually, I'm going to do that. And then we'll go do a course member live. We've got a lot to talk about in the course member live. So we'll do a course member live in probably give you maybe 10 minutes or so. We'll do a course member live. We do still have that flash sale going on for the next 4 hours. So if you want to see exactly what I'm doing with my, $2.5 million trade, what I'm doing. You know, am I buying more? Am I repositioning? Am I going all in on stocks? If you want to be the first to kind of hear my thoughts on how I think these market movements affect my positioning, make sure you're part of those course member live streams. And remember, you can get that perspective for life if you join once. So you join once over at meetkevin.com and you never have to join again, which is nice. So, you know, even in 5 years, if you're watching a YouTube video, you're like, oh, Kevin's got a trade going, let me go see what it is. If you're a course member, you can go check it out, which I think is kind of cool. So go check that out over at meetkevin.com. And I look forward to seeing y'all. Can I watch the past streams if I join as a course member? Yes. What's actually really cool about that is you can watch my course member live streams through COVID. It's crazy. Like, you could literally go back to like March 20th of 2020 if you want, and you could see me buying the dip. Like, it's in like the crazy crash, and I'm just like, yeah, I'm gonna buy a little more. Yeah, I'm gonna buy a little more. Yeah, I'm gonna buy a little more. It's actually pretty cool. So I encourage you to check that out again over at meetkevin.com. Shout out to those of you joining recently. Love y'all. And folks, we'll see y'all soon in the next one, all right? Thanks so much for being here. Goodbye. Good luck. Not personalized financial advice, and we'll see you there soon. Goodbye, everyone.